Here's why 15 million Californians could suddenly lose access to their credit cards. Did you know that over 15 million Californians could suddenly lose access to their credit cards as soon as next week? A new law quietly passed in California is sending shockwaves through the banking world. And financial experts are warning that this could trigger a massive disruption in how credit is approved and used, not just in California, but across the entire United States. This is not just about one state making changes. Major banks are already reconsidering their relationships with California customers, and some may pull out entirely. Credit limits could be slashed overnight. Applications denied for no clear reason. Interest rates frozen, but at a high cost. And if you think this will not affect you because you do not live in California, think again. What starts in California often spreads fast. In this discussion, we are diving into 10 jaw-dropping reasons why this new law could shake the credit system to its core and what you need to do right now to protect yourself. Reason 1: Banks are pulling out of California. Here is the cold truth. Some of the biggest banks in America are already preparing exit strategies from California, and it is happening faster than anyone expected. The new law, which limits how much interest banks can charge and places stricter rules on fees and data privacy, may sound consumer-friendly on paper, but behind the scenes, it is causing chaos. Financial institutions thrive on predictable profit models, and California just flipped that model upside down. If banks cannot make enough revenue from their credit card services under the new regulations, they are likely to pull out entirely or severely limit their offerings. That means fewer credit card options, tougher approval standards, and widespread disruption for millions of everyday people, especially those who rely on credit cards for basic purchases, building credit, or emergency expenses. Remember, this is not speculation. We have already seen this kind of retreat before, like when major insurers left states due to new laws. And when big players exit, it creates a ripple effect, hurting small businesses, consumers, and even other states that rely on those financial systems. So do not be surprised if you wake up next week, go to use your card, and it is no longer accepted. Because when banks pull out, they do not give warnings, they just disappear. Reason 2: Credit card approvals are about to get way harder. If you have been planning to apply for a new credit card, you might want to hit pause. This new law is already pushing banks to tighten their approval standards. And the first group to feel the squeeze will be low to middle-income consumers, even those with decent credit. Here is why. The law is designed to protect people from high interest rates and excessive fees. But it is also cutting into the profits banks rely on to offset the risk of lending to non-prime customers. And when risk goes up and profit goes down, banks do what they always do. They raise the bar. Suddenly, the credit score you thought was good enough no longer is. Your income not high enough. Your credit history too thin. And this is not some distant consequence. It is happening now. Applications are already being flagged for review. People who have never had a problem getting approved are now facing rejections or much smaller credit limits than expected. It is like the rules changed overnight and no one told the players. So if you are relying on that next credit card for a large purchase, to build your credit, or to have as a backup, you need to know what is coming, because if approvals continue tightening like this, millions could find themselves locked out of the credit system entirely. Reason 3: Interest rate caps could backfire. On the surface, capping credit card interest rates sounds like a win for consumers. After all, who would not want to pay less interest, right? But here is the twist. This well-meaning move could actually hurt the very people it is trying to protect. Here is how. By limiting how much interest banks can charge, the law removes their ability to price risk appropriately. That means they can no longer offset the higher risk of lending to people with poor or limited credit histories. So instead of offering credit at lower rates, banks are just denying those applications altogether. Imagine this. You are trying to rebuild your credit. You have made progress. You apply for a starter card and you are ready to prove yourself financially. But then you get rejected. Not because of something you did wrong, but because banks are not allowed to take a chance on you anymore. That is not financial protection. That is a financial dead end. The harsh truth is that these caps could cut off access for millions of subprime borrowers, people who need credit the most. And when legal credit dries up, predatory lenders step in. Payday loans, cash advance apps, hidden fees, sky-high rates that are somehow worse than what we had before. So yes, this law may lower interest for some, but for many, it might mean no credit at all. Reason 4, the rise of sneaky hidden fees. Here is the ugly side of regulation no one talks about. When banks lose money in one area, they find a way to make it back in another. And with this new law slashing their ability to earn through interest and certain fees, many banks are quietly preparing to introduce new, less noticeable charges, the kind that slip under the radar. We are talking about annual fees, inactivity fees, processing charges, and even paper statement fees. All those free credit cards you once relied on, they might not be so free anymore. And the worst part is that these changes do not usually come with big headlines. They are often buried in the fine print of your next billing statement or hidden in a policy update email you will probably skip. Imagine waking up one morning to find out you have been charged a $95 annual fee just for having a card open, or getting hit with a maintenance fee because you did not use your card last month. It is frustrating. It feels unfair. But technically, it is legal. And with the new regulations pushing banks into a corner, it is only going to become more common. So while this law might stop some banks from charging outrageous interest, do not assume you are safe. The cost may just be repackaged and renamed, showing up in ways that are harder to fight but just as damaging. Reason 5, this could spread nationwide. You might be thinking, well, I do not live in California, so why should I care? But here is the truth. What happens in California rarely stays in California. In fact, many major financial institutions are already considering applying these policy changes nationwide, even if they are only required in one state. Why? Because it is easier and cheaper for big banks to standardize their policies across all 50 states rather than create separate systems for California and everyone else. It is like when one airline changes its baggage policy and suddenly they all do it. That is how fast it spreads. So if you are in Texas, New York, Florida, or anywhere else, do not think you are safe. Your next credit card application might be judged using California's rules. Your interest rates, your fees, your approval odds, all of it could be reshaped by a law you had zero say in. And it is not just about credit cards. These kinds of shifts can affect personal loans, car financing, and even mortgages, especially as banks look for ways to recover losses or simplify operations. One state makes a law, the entire country feels the ripple effect. So the question is not if this change will reach you, it is when. And the sooner you understand how it works, the better prepared you will be. Reason 6, smaller lenders could be wiped out. While big banks may have the resources to adapt, smaller lenders and credit unions are in real trouble. These institutions often serve people who are overlooked by major banks, offering more flexible approval terms and personalized service. But under the pressure of this new law, many of them might not survive. Here is why. The law imposes strict limits and reporting requirements that come with high compliance costs. For a local credit union or community-based lender, that means more expenses, more paperwork, and less profit. And unlike the big banks, they cannot just shift their operations or raise millions in new fees to make up for it. If enough small lenders go under, consumer choice shrinks, especially for lower-income families and people in rural areas. That means fewer credit card options, fewer loan products, and less competition, which ironically could lead to worse rates and stricter terms for everyone else. It is like watching the corner bookstore shut down because a giant chain moved in and changed the rules. Only this time, it is your credit access at stake. And once these small players disappear, they rarely come back. So while this law was meant to level the playing field, it might actually eliminate the only lifeline some borrowers have. Reason 7. Buy now pay later could explode. As credit card approvals tighten and access to traditional credit dries up, millions of people are expected to flock to buy now pay later services like Klarna, Afterpay, and Affirm. At first glance, these seem like a lifesaver. No interest, no credit check, instant approval. Sounds perfect, right? But here is the truth most people miss. These services can be just as dangerous as credit cards, if not more. They break purchases into smaller payments, which feels manageable until you are juggling 5 or 6 of them across multiple platforms. Suddenly, your bank account is drained, your budgeting falls apart, and your stress levels spike. Worse yet, many buy now pay later users do not realize they are accumulating debt because it does not always show up on your credit report. That means if you default or fall behind, you could face late fees, collection calls, and even damage to your credit without fully understanding what went wrong. And guess what? With fewer people qualifying for credit cards, these services will only get more aggressive. More ads, more offers, more temptation. But what they do not advertise is how easily this solution can spiral into a debt trap that is harder to escape than traditional credit. So before you click pay later, think twice because the freedom it promises might come with a very real price. Reason 8. Your credit score could take a hit. Here is something most people will not see coming. This new law could actually hurt your credit score, even if you never miss a payment or carry a balance. Sounds strange, right? But the way credit works is more fragile than most of us realize. One of the biggest factors in your credit score is credit utilization, how much of your available credit you are using. If banks start slashing credit limits or closing accounts due to the new regulations, that will shrink your total available credit. And when that happens, your utilization shoots up, even if your spending stays the same. Let's say you have a $5,000 limit and you carry $1,000, you are using 20%. But if that limit suddenly drops to $2,000, you are now using 50%, and that can tank your score fast. What is worse is many people will not even know this is happening until it is too late. No warning, no notice, just a lower credit limit and a score drop that could affect your ability to buy a home, lease a car, or get approved for a loan. All because of changes you had no control over. So now is the time to be proactive. Check your limits. Keep cards open. Spread your spending wisely because this law might protect some people, but it could accidentally punish a lot more. Reason 9. The shift to debit cards comes with hidden dangers. As credit becomes harder to access, many people will naturally turn to what feels like the safer option, debit cards. After all, it is your own money. There is no interest, and you cannot overspend, right? But here is what most people do not realize. Using your debit card for everything might actually be putting you at greater risk. For starters, debit cards do not offer the same level of fraud protection as credit cards. If someone steals your debit information and drains your account, that money is gone instantly. It could take days or even weeks to get it back, if you get it back at all. With credit cards, fraudulent charges are much easier to reverse, and your money is not tied up while you wait. Plus, debit card usage does nothing to build your credit score. So if you stop using credit cards completely because of reduced access or fear of fees, you are also missing out on the opportunity to improve your financial standing. That might not hurt today, but it could down the road when you need to apply for a mortgage, car loan, or rental. Debit cards feel safe until they are not. And as credit restrictions tighten due to this law, more people could unknowingly be setting themselves up for financial vulnerability without even realizing it. Reason 10. Emergency credit could disappear when you need it most. Here is the final and perhaps most dangerous consequence of this new California law. Your emergency safety net could vanish overnight. For millions of Americans, credit cards are not about luxury spending or rewards points. They are a last line of defense. A medical bill, a car repair, a sudden job loss, a family emergency. When cash runs out, credit is often the only thing standing between stability and crisis. But under this new law, that safety net is weakening fast. As banks pull back, tighten approvals, lower credit limits, or shut down accounts entirely, emergency credit becomes harder to access, especially for middle-class families living paycheck to paycheck. Even people who have done everything right financially could suddenly find their available credit reduced or frozen at the worst possible moment. No warning, no grace period, just a declined transaction when you need it most. And here is the cruel irony. Emergencies do not wait for lawmakers or banks to sort things out. They happen now. A hospital does not care that your credit limit was cut last week. A mechanic will not release your car because California changed a financial regulation. When credit disappears, real-world consequences hit immediately. This is where the domino effect becomes truly dangerous. Without access to emergency credit, people are forced into desperate alternatives. Borrowing from friends or family, draining retirement accounts, selling assets at a loss, or turning to high-risk lenders that charge brutal fees. One unexpected expense can spiral into long-term financial damage that takes years to undo. What makes this even worse is that many people will not realize their emergency credit is gone until they try to use it. Credit card companies are not required to explain why limits are cut. They do not have to ask permission. And they certainly do not time these changes around your personal circumstances. This law may have been designed to protect consumers, but if it leaves millions without access to emergency funds, the result could be the opposite of protection. It could create a financial environment where only the wealthy have flexibility while everyone else walks a tighter and more dangerous rope. So what should you do right now? You need to reassess your financial backup plans. Know your credit limits. Avoid maxing out cards. Build cash reserves where possible. And most importantly, do not assume your credit will be there tomorrow just because it was there yesterday. Because the most alarming part of this new law is not higher fees, tougher approvals, or hidden changes. It is the possibility that when life hits hard, credit might not be there to catch you anymore. Conclusion: awareness is your first line of defense. What we have uncovered in this discussion is not just another policy change buried in legal language. It is a warning signal, a loud one. This new California law has the potential to reshape how credit works, who gets access to it, and who gets left behind. And while it may have been introduced with consumer protection in mind, the real-world consequences could be far more complicated and far more dangerous than most people realize. For millions, credit cards are not a luxury. They are a tool for survival. They help families manage emergencies, smooth out income gaps, build credit histories, and stay financially afloat during uncertain times. When that access is restricted, whether through tougher approvals, reduced limits, hidden fees, or outright withdrawals, the impact is not theoretical. It is immediate and personal. What makes this situation especially alarming is how quietly it is unfolding. No mass alerts, no clear warnings, no time to prepare. Changes are happening behind the scenes, decided by banks responding to new rules, not by consumers who depend on them. And once those changes are in place, reversing the damage becomes incredibly difficult. Even more concerning is the ripple effect. As we discussed, California rarely acts alone in the long run. If banks decide it is easier to apply these rules nationwide, people across the country could soon feel the same pressure regardless of where they live. That means this is not just a California issue. It is a national financial shift in the making. The biggest risk of all is complacency, assuming this will not affect you, assuming your credit is safe, assuming you will have options when you need them. History shows us that financial systems do not break all at once. They tighten slowly, then suddenly, and by the time most people notice, the doors are already closing. That is why awareness is your first line of defense. Understanding what is happening allows you to adapt, prepare, and protect yourself. Review your credit, diversify your financial tools, build buffers where you can, and most importantly, stay informed. Because whether you support this law or not, one thing is clear. The rules of credit are changing. And those who see it early will be in a far stronger position than those who find out when their card is declined.